Hi professionals, welcome to Tax Guru YouTube channel. This is CA Rohan R. Pingai, practicing chartered accountant based in Mumbai, partner in Motilal and Associates LLP, member firm of Marks Inc. Welcome to our Tax What Law Says video series, that is particularly case laws discussing reported to ITAT and High Court. Today is a part 3 of video series. Let's dive into it. Allow me to share my screen. What law says? Direct tax part 3. We will going to discuss case laws reported to ITAT and to High Court. First case law. Piramal Enterprise Limited versus DCIT ITA number 306 and 5091 Mumbai of 2010, assessment year 2005-2006, date of order 11th January 2024, and relevant sections are sections 48, section 50A and 55A. Let's understand facts and issue of the case. The assessee had sold a flat. For computing the cost of acquisition of the said flat, assessee adopted the fair market value as on 1st April 1981, based on valuation report of government value. The assessing officer, after rejecting the valuation made by the valuer, calculated the cost of acquisition and thereby made an addition. Aggrieved by the order, the assessee preferred an appeal before the CIT appeals. The CIT appeals upheld the addition. Aggrieved, the assessee preferred an appeal before ITAT. Let's see what tribunal observed and held. The assessing officer had no power. The assessing officer had no power to refer the matter for valuation to the department valuation officer, but rather had power under section 50A of the Act to refer the case to the valuation officer in case the valuation adopted by the assessee was lower than fair market value. Section 50A of the Act is prospective in nature. Section 50A of the Act is a prospective in nature and not retrospective. When the assessee had calculated the cost of acquisition on the basis of the fair market value determined by the government valuer, the assessing officer had no right to replace the government approved valuer's opinion on his own. Thus, the appeal of the assessee was allowed. Next case. Mashreq Bank PSC versus DCIT ITA number 1342, Mumbai, assessment year 2002-2003, date of order 6th February 2025. Relevant sections are section 44C, article 7, sub-article 3, article 25, sub-article 1, India UAE double tax avoidance agreement. Let's understand facts and issue of the case. The assessee, a tax resident of the UAE, assessee was a tax resident of the UAE, engaged in banking business in India through branches. The branch claimed deduction towards expenses incurred by HO without any restrictions on the bottom of deduction. Further, it claimed certain expenses that were directly incurred outside India by HO. However, they were related to business operations of Indian branch. The assessing officer restricted deduction of HO expenses to 5% of average adjusted total income by applying section 44C. Further, the assessing officer denied deduction for certain expenses that were directly incurred by HO for branch operations. Let's see what tribunal observed and held. Article 7, subarticle 3 deals with determination of profits of permanent establishment. Okay, Article 7.3 deals with determination of profits of P. It provides for deducting all expenses. It provides for deducting all expenses incurred for P business, including general administrative expenses. The article didn't restrict quantum of deduction or provided for reference to domestic law. The scope of Article 25 sub Article 1 as regards computation of business profits can't be interpreted in a way that imposes restrictions on the manner of computing tax liability under Article 7 sub Article 3, or to read restrictions under domestic law into double tax avoidance agreement. Article 25, sub-article 1 and Article 7, sub-article 3 operate differently, as the former deals with eliminating double taxes, this 25.1 deals with eliminating double taxes, and latter, that is 7.3, deals with determining business profits. Therefore, Article 7.3 is an express provision that overrides the provisions of Section 44C of the Act. Circular number 649, dated February 1993, provides that while computing business profits, the expenditure covered by Section 44C must be allowed without imposing any restriction. Therefore, an expenditure exclusively incurred outside India for Indian branches must be allowed as a deduction without any limits. Next case, Union Bank of India versus DCIT ITA number 3740 Mumbai of 2018 and 424 Mumbai of 2020, assessment year 2013-14 and 2015 and 16. Date of order 6th September 2025 and relevant section is section 115G. Let's understand facts and issue of the case. Assessing officer asked to assessee to furnish the computation of book profit and asked why provisions and contingencies debited to the P&L should not be added back under section 115 JB. Assessee in response submitted that the provision of section 115 JB was itself not applicable to the assessee. What assessee was submitted in response that the provision of section 115 JB was not applicable to them. However, the assessing officer rejected the assessee's plea. On appeal, on first appeal, the CIT appeals upheld the order of the AO. Aggrieved, assessee filed an appeal to tribunal. Let's see what tribunal observed and held. The term company refers to entities formed and registered under the Companies Act, not banks constituted under a special statute. Okay, what company means is entity formed and registered under the Companies Act and not banks constituted under a special statute. The deeming fiction in the Banking Companies Acquisition and Transfer Act 1970 is limited to income tax purposes and doesn't confer company status under corporate law. This is very important. The proviso to section 115 JB subsection 2 explicitly exempts any banking company. Proviso to section 115 JB subsection 2 explicitly exempts any banking company and similar entities from compliance of case and accounting policies as per the Companies Act or Schedule 3 of the Company Law. Clause B of section 115 JB subsection 2 doesn't extend to corresponding new banks. Since these banks are not companies under the Companies Act, they fall outside the ambit of MAT, mandate under this clause. Therefore, MAT on book profits under section 115 JB is not applicable to Union Bank, Central Bank for assessment year 2013-14 and assessment year 2015-16. Next, Anil Dattaram Pitale versus ITO, ITO number 465, Mumbai of 2025, AY 2018-19, date of order 17th March 2025, relevant section is section 56, subsection 2, clause 10. Let's understand facts and issue of the case. The assessee purchased a flat in financial year 1997-98. The society entered into a redevelopment scheme with a builder. As per the agreement, the original flat was surrendered, extinguished, and the assessee was allotted a larger replacement flat. The AO treated the differential value between the new flat stamp duty value and the index cost of the old flat as income from other sources under section 56, subsection 2, clause 10. The assessing officer treated that differential value as income from other sources. The CIT appeals upheld this addition, aggrieved the assessee filed an appeal before ITAT. Let's see what tribunal observed and held. The exchange was part of a redevelopment agreement resulting in the extinguishment of the old flat and acquisition of new larger flat, not an outright receipt for inadequate consideration, not an outright receipt for inadequate consideration. No cash or other assets were received separately. The transaction was more akin to a swap under pre-agreed terms. Section 56, subsection 2, clause 10 applies when property is received for inadequate consideration, implying it's a gratuitous receipt. When 56 to 10 applies when property is received for inadequate consideration. Here, the new flat was received in lieu of the old flat, implying adequate consideration via the redevelopment agreement. At most, the transaction qualified as capital gains event under section 45. The assessee was entitled to claim exemption under section 54 as the entire capital gain was suitably reinvested by acquiring the new flat. The tribunal the tribunal deleted the addition made under section 56, subsection 2, clause 10, ruling that the redevelopment exchange didn't constitute a receipt of property for inadequate consideration. The transaction was held to be a capital gains event with exemption claimable under section 54, resulting no tax liability. Next, Rabin Arup Mukerjea versus ITO, ITA number 5884, Mumbai of 2024, assessment year 1670. Date of order 21st March 2025 and relevant section is section 56, subsection 2, clause 7. Let's understand facts and issue of the case. Assessee, a non-resident Indian, received a flat in Worli, Mumbai by registered with deed from his state sister. Please note down or understand. Received from state sister. Assessing officer was of the view that state siblings are not relatives under section 56, subsection 2, clause 7, and hence the gift valued at around 7.5 crore was taxable as income from other sources. A notice under section 148 was issued and the amount added to income. CIT appeals confirm this view. What tribunal observed and held noted that state siblings are connected by affinity. State siblings are connected by affinity recognized in several statutes, for example, RBI Act, Companies Act, and are more commonly accepted as brother and sister. Cited Black's Law Dictionary and Common Law Principles, relative includes individuals related by marriage, affinity, including state siblings. Since the IT Act doesn't explicitly exclude step siblings, their inclusion as relatives is permissible under general and legal definitions. Step siblings qualify as relatives under explanation to section 56, subsection 2, clause 7. The gifted flat being from a relative, the transaction is exempt from tax. The tribunal deleted the addition holding no taxable income under section 56. Now we will move to cases reported to High Court. First, Uttar Gujarat Vij Co Limited versus ITO 2025-473 ITR 729 Gujarat, assessment year 2010-11 and assessment year 12-13 to 14-15. Date of order 1st April 2024. Relevant section is section 254. Let's understand issue of the case. Issue of the case: whether the Income Tax Appellate Tribunal, that is ITAT, may exercise rectification powers under section 254 subsection 2 to correct an order that failed to follow binding precedent laid down by jurisdictional high court, even if such rectification results in remand to the tribunal. What was the issue? Issue was whether ITAT may exercise rectification power under section 254 subsection 2 to correct an order that failed to follow binding precedent laid down by whom? Jurisdictional high court, even if such rectification results in remand to the tribunal. Let's see what Gujarat High Court observed and held. The High Court reaffirmed that orders of jurisdictional high court are binding on the ITAT under its territorial jurisdiction. If the ITAT delivers an order that doesn't conform to such binding high court precedents, it must rectify that error. Section 254 subsection 2 empowers the ITAT to correct such mistakes to ensure its orders align with established legal positions, and this power includes remanding the matter back to itself for fresh adjudication in line with binding judgments. The High Court set aside the ITAT's original order for failing to comply with binding Gujarat High Court precedent, held that the ITAT possesses the jurisdiction under section 254 subsection 2 to rectify its own order even if it leads to reconsideration of facts or law consistent with higher court rulings. Accordingly, the matter was remanded to the ITAT for fresh hearing and decision in conformity with binding legal position. Next, CIT versus Ramco Cements Limited 2025-474 ITR 9 Madras, assessment year 2017-18, date of order 19th December 2024. Relevant sections are section 143 subsection 3, section 144B, and section 144C subsection 30. Let's see what was the issue of the case. Whether the time limit under section 144C subsection 30 for the assessing officer to complete the final assessment after receiving dispute resolution panel, that is DRP directions, begins from the date the DRP order is uploaded on the portal, that is in this current case 31st January 2022, or the date the AO, that is assessing officer, actually receives that direction, that is the 3rd February 2022 in current case. What was the issue? Issue was whether the time limit under section 144C subsection 13 for the assessing officer to complete the final assessment after receiving DRP directions begins from the date the DRP order is uploaded on the portal or the date the AO actually receives the direction. Let's see what Madras High Court observed and held. Section 144C forms a separate code prescribing strict timeliness of 30 days from the date DRP directions are received by AO for completing the final assessment. The DRP's directions being online accessible on 31st January 2022 mean both AO and the assessee could view them. Thus, the AO received the directions on that day, not on 3rd February. The final assessment order passed on 22nd March 2022 fell outside the 30-day window from 31st January, rendering it time-barred under Section 144C, subsection 30. Accordingly, the Madras High Court dismissed the revenues appeal, setting aside the assessment order as barred by limitation. Next, Everest Cantos Cylinder Limited versus Deputy or Assistant CIT 2025 473 ITR 148 Bombay, assessment year 1718, date of order 4th July 2024, and relevant sections are section 147, 148, 148A, clause D, and 151A. Let's see what was the issue of the case. Issue was whether notices issued under section 148A, clause B, the subsequent order under section 148A, clause D, and reopening notice under section 148 issued by the jurisdictional assessing officer were valid, given that section 151A and a relevant notification dated 29th March 2022 require such notices to be issued only through a faceless or automated mechanism. What was the issue? Issue was whether notices issued under section 148A, clause B, subsequent order under section 148A, clause D, and a reopening notice under section 148 issued by the jurisdictional assessing officer were valid, given that section 151A and a relevant notification dated 29th March 2022 require such notices to be issued only through a faceless automated mechanism. Let's see what Bombay High Court observed and held. Section 151A, along with 29th March 2022 notification, mandates that all notices under section 148A, clause B and 148B issued exclusively via faceless scheme and through automated allocation, and not by the jurisdictional assessing officer. It should be exclusively via the faceless scheme and through automated allocation. Since the impure notices dated 20th March 2024 under section 148A, clause B, the order dated 24th April 2024 under section 148A, clause D, and the ensuing 148 notice were issued by the joint assessing officer, not faceless. Jurisdictional assessing officer, not faceless. The High Court held them to be illegal and invalid because it is not faceless. Consequently, the reassessment proceedings initiated under section 147 were also quashed, and all these notices or orders were set aside. Let's see today's last case. ATS Infrastructure Limited versus ACIT 2025 473 ITR 595 Delhi, assessment year 2014-15 to 16-17. Date of order is 18th July 2024, and relevant sections are sections 147, 148, 148A, clause E, and 148, clause D. Let's see what was the issue. Issue was whether the reassessment proceedings initiated by issuing a notice under section 148A, clause B, followed by an order under section 148A, clause D, and subsequently a notice under section 148 are valid when the assessing officer initially recorded a reason to reopen based on alleged loan receipt from its 100% subsidiary. Later, the AO relied on a different ground, incomplete explanation of source of repayment, not included in the notice of reasons recorded originally. Let's see what Delhi High Court observed and held. The original reasons recorded by the AO, that is, loan received from subsidiary, must form the sole basis for reopening under Section 147 or 148 relies on fresh or different ground such as unexplained repayment source not part of the original written record or notice is impermissible. Not part of the original reason record or notice is impermissible. The assessing officer cannot expand or alter the foundational basis after issuing the section 148A clause D order. Any deviation undermines the reassessment validity. Explanation 3 to section 147 doesn't permit this expansion. Once it is established that reassessment was based on a new ground not included in the original reasons, the entire proceeding, that is order and notice under section 148A clause D and 148 becomes invalid. The High Court accordingly quashed the notices and order. Therefore, reassessment proceedings were illegal and rightly set aside. This is all for the day part 3 under direct tax. Note down my contact numbers. If you have any query or question, please let me know and connect it to the Tax Guru YouTube channel for daily updates. Hope you are getting the good knowledge information from this video series. If you really worth of it, then do like this video, also share in our professional network, and also subscribe to Tax Guru YouTube channel. We'll meet in next video. Till then, see you soon.